Welcome to Market Pulse by Orestes Capital, your daily briefing on the key market moves, sector trends, and investment themes shaping the day. Today is Monday, July 6, 2026. We're Elena and Marcus.
To start the week, today's data deck reveals a market defined by these stark, almost violent contradictions. I mean, if you rely solely on headline index numbers, you're missing the underlying mechanics of a really historic divergence.
Correct. Right now, everyday retail investors are pouring $14 billion into the equity markets. But at the exact same second, Wall Street institutions are pulling $14 billion out.
Someone is about to lose a massive game of chicken. We are moving far beyond that simple AI enthusiasm narrative and entering a period of severe mechanical rotation.
Understood. Our daily outline covers the four main themes driving this divergence. In Block 1, we'll unpack the macro data, specifically a massive miss in domestic job creation that completely conflicts with stubbornly anchored long-term interest rates.
Right, and that frozen housing market. Then in Block 2, we dissect the sector and equity flows, where we evaluate that $14 billion retail versus institutional battle.
Along with that structural shift in tech toward what we call agentic commerce.
Indeed. In Block 3, we analyze commodities. We're seeing major price actions in WTI crude and precious metals as those geopolitical risk premiums just evaporate.
And finally, in Block 4, we will synthesize all these moves to isolate a hidden vulnerability, specifically a $40 billion crowded currency trade that could trigger widespread volatility.
Moving to today's data, we begin with Block 1, macro and global rates. The institutional focus is heavily weighted toward the June non-farm payrolls report, which printed significantly below expectations.
Yeah, the domestic economy added a mere 57,000 jobs. That entirely misses the institutional consensus range of 110,000 to 113,000.
Right. A 57,000 print is, well, it's essentially recessionary territory, yet the official unemployment rate actually ticked downward to 4.2%.
Applying the first principles rule here for our listeners, trying to reconcile those two numbers. How exactly does a severe miss on job creation result in a lower unemployment rate?
It comes down to the denominator, really, the labor force participation rate. The unemployment metric only measures individuals actively seeking employment.
Right.
Our daily desk data shows labor force participation dropped sharply to 61.5%. Mechanically, we aren't seeing a lower unemployment rate because the economy is generating opportunities.
We're seeing it because a large cohort of workers just completely exited the labor pool.
Correct. Whether it's driven by early retirements or discouraged job seekers, a shrinking labor force artificially depresses the headline unemployment figure.
And this structural weakness in the labor market immediately repriced short-term rate expectations. The probability of the Federal Reserve executing a July rate hike plummeted this morning to just 25.1%.
Right. If the Fed's dual mandate relies on maximum employment and stable prices, that 57,000 print heavily restricts their ability to hike.
Indeed. However, while the short end of the curve is pricing in a pause or even cuts, long-term borrowing costs refuse to budge. The 10-year Treasury yield remains stubbornly anchored at 4.48%.
The bond market is signaling a clear lack of confidence in the Fed's ability to tame services inflation.
Investors are demanding a 4.48% premium to lock up capital for a decade because they foresee persistent structural inflation regardless of a softening labor market.
On that point, that anchor 10-year yield is the direct mechanism keeping the United States housing market in a state of paralysis. Our latest run on mortgage data highlights a staggering statistic.
Yeah, 80% of U.S. homeowners currently hold mortgage rates below current market pricing.
The financial golden handcuffs.
Exactly. It operates as a liquidity trap for residential real estate. Homeowners cannot afford to liquidate their properties because moving requires abandoning a fixed 3% mortgage to originate a new loan at 7%.
Right. The monthly carrying cost for the exact same square footage literally doubles.
Consequently, existing home supply drops to near zero, which paradoxically keeps home prices elevated despite record-high borrowing costs.
Understood. But while the consumer is trapped, the high-rate environment is a massive operational tailwind for financial institutions.
Right. If we look ahead to Q2 earnings, our data flags major money center banks like Wells Fargo, Bank of America, and Citi as prime beneficiaries.
Let's break down the mechanics of why these banks thrive when the yield curve is elevated. It centers entirely on the net interest margin, or NIM.
Banks gather deposits from consumers, often paying close to 0% on standard checking accounts, and lend that capital out, or they just park it in risk-free government paper yielding upwards of 5%.
Correct. And the wider that spread stays open, the more frictionless capital the banks generate.
Indeed. Furthermore, the dealer desks indicate these banks are projecting a surge in capital markets and IPO fees.
Right. When equity markets hover near all-time highs, corporate entities rush to issue public stock, and the underwriting banks collect massive toll revenues.
Main Street remains frozen in their current homes, while Wall Street financial institutions harvest the spread.
Moving to today's data for Block 2, sector and equity flows. If we examine the broader indices, the Nasdaq 100 surged 1.26% today, and the S&P 500 gained 0.72%.
A casual observer would assume a robust market, but our daily desk data shows the equal weight S&P 500 was essentially flat.
Which indicates abysmal market breadth. The upward momentum is an illusion created by a handful of mega-cap technology and communication services companies.
Right, they're just dragging the capitalization-weighted index higher while the median stock goes nowhere.
Which brings us to the $14 billion game of chicken. Everyday retail investors generated a massive net buy imbalance of exactly $14 billion last week.
Simultaneously, global equity funds experienced institutional outflows of exactly $14 billion.
Retail's aggressively buying the dip, driven by FOMO, the fear of missing out.
Yeah.
But I want to challenge the institutional side of this trade. Why are the sophisticated asset managers and commodity trading advisors, the CTAs, fleeing a market that continues to grind higher?
They are fleeing because algorithmic, positioning-driven markets are inherently fragile. Systematic long-short funds don't buy stocks based on long-term fundamental corporate value.
Right, they buy mathematical momentum factors.
And over the last 2 weeks, those quant momentum strategies have suffered brutal drawdowns, down over 3%, while systematic long-short funds dropped over 2%.
To put that in perspective for you, the listener, imagine a supertanker navigating a narrow canal. Systematic momentum funds operate like that supertanker. They require long, predictable trends to generate returns.
A momentum algorithm simply buys assets that are rising and shorts assets that are falling.
Correct. When the market violently rotates, for example, when capital suddenly floods out of speculative hardware stocks and into established software platforms, the supertanker cannot make a U-turn fast enough.
The models break. The current data shows unconstrained momentum factors are suffering their worst drawdown since the first quarter of 2023.
Understood. And that violent rotation is entirely centralized within the artificial intelligence sector. We are transitioning from the speculative infrastructure phase into a phase defined by agentic commerce.
As of June 2026, enterprise AI adoption has officially reached 20.6%.
We need to define agentic commerce mechanically. For the past 3 years, AI has largely functioned as a passive assistant, a chatbot that answers queries.
Right. Agentic commerce means deploying autonomous AI agents that can execute multi-step workflows. We are talking about software that negotiates supply chain contracts, routes logistics, and executes financial transactions without human oversight.
Indeed. The market is now rewarding tangible revenue generated by these systems, rather than vague promises of future AI capability.
We saw this rotation manifest clearly in today's individual stock movers. Broadcom jumped 3.7% and Apple rose 1.3%.
This wasn't driven by hype. It was driven by the announcement of a concrete ASIC chip partnership extending through 2031.
The distinction between general-purpose hardware and ASIC chips is critical here. ASIC stands for Application-Specific Integrated Circuit.
Right. Unlike a standard graphics processing unit, or GPU, which is built to handle a wide variety of computational tasks, an ASIC is hardwired at the silicon level to perform one highly specific task with extreme efficiency.
By partnering on ASIC development, Apple and Broadcom are locking in a closed-loop hardware ecosystem. It provides tangible, contractual revenue visibility for the next 5 years.
On that point, compare that to NVIDIA, which managed only a fractional 0.4% gain today. They spent the morning engaged in damage control.
Yeah, publicly rebutting an unverified rumor regarding a 12-month delay for their Kyber NVL144 server rack system. Management had to explicitly state their roadmap is intact merely to prevent a sell-off.
It signals a fundamental shift in investor expectations. Capital expenditure on AI hardware is no longer given a free pass. The demand has shifted from building the infrastructure to demanding operational efficiencies.
Look at Meta. Their stock advanced 3.0% today, following reports they are exploring the sale of their excess compute power.
That implies Meta has either over-provisioned their hardware or optimized their internal models so effectively that they can now monetize surplus server capacity.
Conversely, Microsoft shares declined 1.0% today. Our proprietary updates confirm they are initiating thousands of job cuts this week.
Explicitly targeting headcount efficiencies generated by internal AI deployment. The software engineers and administrators who built the initial wave of AI infrastructure are now being displaced by it.
Correct. The institutional money is rotating directly into the hyperscalers capable of capturing these margin expansions and aggressively shorting speculative hardware plays.
Moving to today's data for Block 3, commodities and hard assets. While domestic markets wrestle with labor data and tech rotations, the global macroeconomic picture is delivering a massive disinflationary shock via the energy sector.
Right. WTI crude oil cratered to a 5-month low today, settling below $69 a barrel.
The catalyst is coming straight from the Middle East. Saudi Aramco slashed its Arab Light official selling price by $11 a barrel.
Our historical models flag this as the largest single price cut in at least 26 years. Saudi Arabia is aggressively defending its Asian market share.
Indeed. And they are forced to discount heavily because the geopolitical risk premium has entirely evaporated from the market.
The shipping bottlenecks are clearing. The latest data indicates flows through the Strait of Hormuz have recovered to 18 million barrels per day,
which represents roughly 80% of pre-war levels. The physical supply of oil is reaching the market unimpeded.
When supply chains normalize, speculators dump their disaster insurance. We tracked $1.4 billion in capital flying out of the broader commodity sector last week alone.
Precious metals, which are typically held as a safe haven during geopolitical stress, experienced the largest single-week outflow at negative $884 million.
This capital flay is creating collateral damage across industrial and energy equities. The XLE energy sector ETF significantly lagged the broader market today.
Even dominant industrial players are feeling the macro rotation. Nucor, the largest domestic steel producer, is down 12% over the trailing month.
We should contextualize Nucor's drop, though. Despite the 12% monthly drawdown, they remain up 30% year-to-date because they continue to aggressively capture market share in flat-rolled steel production.
Correct. However, a 12% reversal in a single month illustrates how rapidly institutional capital will abandon cyclical industrials when global growth projections soften and commodity prices plunge.
Which brings us to Block 4, the synthesis. Let's connect these cross-asset moves. We have a domestic labor market missing expectations, momentum funds suffering drawdowns, and a historic plunge in crude oil prices driven by Saudi market share defense.
For the Federal Reserve, 69 oil is the ultimate disinflationary force. Cheap energy mechanically lowers the input costs for manufacturing, transportation, and logistics across the entire supply chain.
Right. It provides the Fed with the exact macroeconomic cover they need to eventually execute a soft landing.
Understood. But there is a latent systemic risk hidden in the currency markets. Today's positioning monitors reveal that speculators are currently holding $40 billion in long U.S. dollar positions.
This is the highest level of speculative dollar crowding since 2015.
I want to break down the mechanics of a crowded currency unwind. A long U.S. dollar trade is essentially a bet on yield differentials.
Capital flows globally toward whichever sovereign debt offers the highest risk-adjusted interest rate. As long as the Fed holds rates higher than the European Central Bank or the Bank of Japan, the dollar strengthens.
But what happens mechanically if the $69 oil and the 57,000 jobs print finally force the Fed to signal an imminent rate cut?
It triggers a cascading liquidation event. If the Fed pivots dovishly, the yield differential narrows. The fundamental rationale for holding those dollars vanishes.
Right. The speculators holding that $40 billion are heavily leveraged. As the dollar starts to slip, it triggers automated stop-loss orders.
Those traders receive margin calls from their prime brokers, forcing them to sell the dollar at market price to cover their leverage.
Which pushes the dollar even lower, triggering the next tranche of stop-losses.
Correct. It becomes a violent, self-fulfilling feedback loop. And because currency markets dictate the valuation of multinational corporate earnings, a rapid dollar unwind introduces severe volatility into the very mega-cap tech stocks holding up the S&P 500.
On that point, as we look ahead to tomorrow's session, the primary catalyst to monitor is corporate earnings out of Asia. Samsung is scheduled to release its preliminary Q2 earnings.
The institutional consensus anticipates an 18-fold jump in operating profit, driven entirely by memory chip demand.
Samsung will serve as the definitive acid test for the AI demand narrative. It will either mathematically validate the retail sector's aggressive $14 billion buying spree,
or it will expose underlying cyclical weakness and vindicate the institutional exodus.
Indeed. We'll leave you with this synthesis to monitor over the coming weeks. We are witnessing AI graduate from an infrastructure build-out into a tangible macroeconomic force.
With 1/5 of corporations now adopting agentic commerce and massive entities like Microsoft substituting human labor for automated efficiency, we are staring at structural, technology-driven disinflation.
Correct. If AI permanently suppresses corporate operating costs and eliminates labor bottlenecks, it could be the ultimate mechanism that forces the Federal Reserve to aggressively slash rates.
And only a severe drop in the cost of capital will finally shatter the golden handcuffs keeping the U.S. housing market permanently frozen.
It remains the most consequential cross-asset theme of the quarter.
Thank you for listening to Market Pulse by Orestes Capital. We're Elena and Marcus. We'll be back tomorrow with the latest market color.